Good day, everyone. As you can see, oh, wait, hold on a second. Actually, Gil, can you show the global monetary policy stance chart? It's I think I sent it to you.
Is that the one? Yeah, that's it.
Yeah, that's so that illustrates how central banks normally cut rates when markets make lows. But in this brave new world where stealth QE in all its forms spurs global liquidity to pay for record levels of debt, pensions, and global boomer debts, these global central banks now ease when markets are at new highs. So based on the last 30 years of data, this is different. And meanwhile, total assets in money market funds have hit a record $7.7 trillion, which means it's tripled over the last 8 years. The top 10 stocks now make up 41% of the S&P 500, which is an all-time high. And the Magnificent Seven's share has also hit a new record of 35%. So out of 500 stocks, just 10 are driving the entire index. Monetary expansion into these trillion-dollar companies is part of the explanation, where fund managers have to keep up with their bogeys. But the deeper explanation is that the internet / AI economy is overtaking the legacy economy. And some say this is similar to the dot-com boom, then bust of 2000, but valuations can go to extremes before bubbles burst. And this bubble may have a ways to go, as these mega cap companies are driving record profits and revenue growth year over year, which is spurred by bleeding edge tech. Now, there are some who've also raised the issue of the inflationary tariffs. But by placing the tariffs on imports, there's the claim that consumers are required to pay a higher price, and that would make tariffs a tax. But that has not yet happened. And the Fed Chair Powell said it himself the other day that we're now collecting a good bit of revenue, $300 or $400 billion a year pace from tariffs. Who's paying that? So far, it looks like it's the middle group, retailers and importers. They're not passing along to consumers that much of the cost. The actual impacts on inflation have been quite modest so far. It's a small amount, unquote. So Powell is saying the previous consensus on tariffs is wrong. And in fact, Trueflation shows that inflation has dropped from over 3% at the start of the year to only 2.05%. Keep in mind, its inflation statistics are based on the rate of change in a broad basket of goods and services weighted by consumer spending patterns, not just a few categories. Trueflation's drop from 3 to 2% means that the overall rate of price increases has slowed in the full basket of tracked goods and services. Sectors outside of food and energy, especially housing-related components, have experienced flat or falling prices, and that brings down the core inflation rate, which accounts for a large share of the total inflation. So the Fed and Trueflation are telling us that tariffs don't bring inflation. Many still don't believe it because the cost of essentials, from food to energy to housing to education to healthcare, all the things we need, continue to climb, albeit at a slower pace. The discrepancy is partly due to deflationary AI and the tariffs, which at least are not inflationary so far. And it could be also due to doctored data, which skew the results in favor of lower inflation. But either way, markets vote with their capital based on the numbers, whether doctored or not. So the march to new highs for leading stocks and major averages continue overall. And we've got the GDP that's surging higher as the impact of AI is felt. Companies are growing faster and doing more with less employees. Efficiency is taking over the market. The government is capturing hundreds of billions of dollars in newfound tariff revenue. Interest rate reductions are another tailwind. In the words of William O'Neill, never argue with the market. Indeed, the evolutionary path of AI continues onward and upward, spurring uranium stocks to new highs. Uranium ETFs such as URA continue to trend higher. We've been sending reports on some of these to members. And there's also been a paradigm shift that 4-year degrees university degrees. Leaving a student saddled in debt was the safe traditional path. It required a student to believe that industries would not get disrupted and that their learned skills would remain of use. The reality brought on by AI, hype and all, is that industries are being disrupted and skill sets need to be constantly upgraded. Job security died when the half-life of skills dropped below the half-life of careers. Layoffs across a broad spectrum of industries, including tech, due to AI automation, show that traditional employment is a risky proposition. As quarterly profits at companies rise with a smaller workforce, job security is at a major low and trending lower. So today, climbing a corporate ladder carries greater risk. Instead, one has to be self-reliant. Founding a company has become statistically safer than climbing a corporate ladder. As an entrepreneur, you may fail, but you'll fail forward with transferable skills with a larger network on and offline. While massive tech layoffs hit 150,000 workers since 2023, we have successful entrepreneurs built lasting value and optionality. The ability to code, create, and raise money is growing rapidly, which will eventually create more jobs, which will outnumber the number of jobs destroyed. But in the meantime, expect escalated demand for energy, which is the lifeblood for AI compute. Uranium companies are benefiting greatly. Now, overall, $1 billion a day is being invested into AI, and that's estimated to grow to $3 billion a day by the end of the decade. The leading AI-related names continue to trend higher, which explains the Magnificent Seven and Oracle, as this is the field that is exploding while traditional employment is shrinking. Incidentally, the second quarter real GDP number revised higher to 3.8%, which is significantly higher than the estimated 3.3% from economists. Now, all that said, in the shorter term, markets have not appreciated Powell's recent hawkish declaration on potentially fewer rate cuts. Markets had also gotten ahead of themselves as the S&P 500 went 107 sessions without a drop of 2% or more, and that's the longest streak in more than a year. So weakness in leading names and major averages are no surprise, as both the S&P and NASDAQ composite pull back to their respective 20-day moving averages, and Bitcoin-related names such as GBTC trade under their 50-day averages. Gil, how are you seeing everything?
Yeah, I think the whole AI thing is actually feeding an inflationary bubble. I mean, they're just throwing money at it and building out all of this infrastructure where with questionable ROI. I heard one analyst talking about how when you look at the amount of money that's being borrowed and spent to build AI data centers, you're essentially investing money in order to earn a potential yield that's equivalent to the 10-year treasury, just based on the rates. A lot of it's risky stuff, 12% debt, and then the return on equities or return on investment that's expected. To me, it looks inflationary. And so you're feeding another bubble, just as we fed bubbles in housing, in office space, in other areas of the economy. So that's what it looks like to me. So as far as the market goes, which is really what I'm more concerned about, because we can babble about AI all day long, if that's all we really want to do. I think that what you've been seeing basically is a lot of areas of the market weakening. And if you look at economically sensitive areas, let me just take a look at, show you some of what I'm looking at. We know that home builders have been weak, and some of these have been shorts. So home building, I thought it's supposed to benefit from lower interest rates. The only problem is the 10-year yield has been rising, and so the Fed can't control that unless they start doing some sort of QE, which they might. You see DR Horton is a short at the 20-day line. Nice reversal on KB Home. They reported earnings last night, and it opened up, ran up, and reversed, so that a little bit of a bull trap there, and now they're taking it in. NVR short at the 20-day line. Pulte Group a short at the 20-day line. Toll Brothers is short at the 20-day line. If we look at airlines, Bill Neal used to tell me that there are certain groups that are canaries in the coal mine, because as an economy weakens, people will cut back at the margin. And what businesses exist at the margin? Well, going on vacation would be one of them. But there's always, airlines have one thing going for them, which is that there's always a certain amount of travel based on business and whatnot. It's not always vacation. So, but it's still one group to watch. And as you can see, these airlines have been rolling over. Many of them have been shorts on the way down. I mean, even Southwest today, maybe a short at the 50-day line. And if we look at another area where people will cut back at the margin, again, are restaurants. And these actually have been weak for a while. So this is kind of, making plain the underlying weakness in the economy. And there's still inflation out there. I've seen the true-flation numbers. I don't know what they're looking at, but I suppose you can massage it any way you want. But from my perspective, you go out shopping for anything, prices are going up. Insurance is going up. I mean, everything's going up. We have our HVAC system, our heating system, checked every year, and this year it would cost $100 more than it did last year to have that done. So there you go, and I think that's like 35% inflation right there. Anyways, but you can see all these restaurants, the majority of them have been in trouble for a while. So this has been, one area that has been signaling a red flag. Here's McDonald's potential short at the 50-day line. And then, of course, you can look at, let's see what else we got going on here. If you look at mortgage names, which are corollary to the housing thing, you can look at, I'm going to bring up, let's go. Well, let me see if I can hit the right button here. But if you look at mortgage names, for example, here we go, mortgage lenders. These are starting to roll over. Some of them have been rolling over even more. Fannie Mae, which is one that the government's buying into. So, and that sort of business, I think, is just absurd. It's socialism. Nationalizing or having the government get involved in companies is not going to make them any better. It's going to prop them maybe, like they've been trying to do with Fannie Mae. But you can see this triggered a short yesterday at the 10-day line and the 20-day line, and doing the same thing today. So other names in the group that are big names, you can see Annaly Capital Management. That's already been a short for the last week. So again, the whole point here is that you're seeing this weakening. Okay, and it's been steady in certain areas of the market. And meanwhile, the whole FOMO thing is in full force with AI and semiconductors, many of which have been shooting higher, but also a number of which have also been rolling over. So, some of these have corrected over the last week. Broadcom coming down. Intel's moving up. Why? Because the government's involved, and now NVIDIA's investing, what was it, $5 billion, which is probably a drop in the bucket for them. So, but NVIDIA has this curious business model. It'll invest in companies like CoreWeave is one of them, and then they just announced they're going to invest in $100 billion in OpenAI. But they invest money in these companies, and they're basically AI cloud companies. They buy into NVIDIA's chips, and then NVIDIA leases compute time on those chips. So it's not your typical swap where you're doing sort of a kickback sort of thing. It's just a little more complicated than that, but that's essentially what they're doing. And so we'll see what kind of ROI they get out of this, but it sure smells like a bubble to me. So I don't get excited about it. I'll trade it. One of my best names is one I talked about a few weeks ago when it was just starting to pop out of the $20 level, was Iron, and it's still going. So, you don't really have to think too much about that one. And of course, my logic here is that with so many of these names suffering from huge PE expansions, Iron was 18 times forward estimates back here when it was sitting around 20. We talked about it in the weekend review, formerly the focus list review, and it's done well. So, I don't have to mess around. I don't have to kiss all the babies, just the right ones. But, if we look at getting back to the semiconductors, and a lot of these, moving higher on the whole, just the whole build out of AI. So, and it's a build out. I don't really understand what's deflationary about it, because there's nothing really that's impacting prices in terms of AI. It makes things cheaper. I don't know. I don't really see it. So does it grow food? I don't really see it. Does it build houses? I don't really see it. So, does it get rid of workers? Yeah, but will they go somewhere else? I don't know. We'll find out. And claims that it's going to create some sort of jobs boom elsewhere in the economy, I think, are mostly speculation. So I don't really buy into it. Here's NVIDIA. It's trying to post a shakeout in the pocket pivot at the 50-day line. So if you really like it, I guess you could buy it here. I'm a little skeptical, but you can play it that way. And then if it breaks the 50, then it's a sell and possibly even a short. Micron, this is when I shorted into earnings. It got up as high as 174 and change, and now it's still coming down. Held the 10-day yesterday, looked like a shakeout at the line, but then it gapped lower today. So not looking so hot. Marvell, the company announced that they're going to buy $5 billion worth of their stock. So there you go. So apparently they think it's cheap. Microchip short at the 20-day line. Lam Research, another one of the semiconductor equipment makers, they all got on fire or caught fire when ASML announced that they were teaming up with some AI company to create smarter AI-driven semiconductor equipment that'll more efficiently and more quickly create more AI chips, which is what we all need, right? And then ARM busting the 50-day line. Arista Networks having some trouble along the 20-day line. So you can see what I'm talking about. So there's nothing really that I want to buy here. And you have these FOMO groups that went nuts, and now they're starting to come in, and they'll come in really hard. But you're seeing this morning, what it feels like to me is that you're getting a sell-off. You had this yesterday, and we've seen this on the way up, where you get these hard sell-offs, wham, 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 wham. And now we're getting this one. You found support at the 20-day line, which looks logical. We'll see how this plays out throughout the day. But it's like somebody's dumping stock. And then there's so much FOMO out there, and there's so much media attention to how AI is the greatest thing on the planet. Everybody needs to get in now because you're going to make 1,000 times your money. You even see those ads now. There's one guy who has really bad teeth. And my thinking is if someone is a successful investor, then they should at least have good teeth, right? Because you can afford dental care. I'm trying to remember the guy's name, but he's got, you click on the link below or call this number and we'll tell you that the one stock that's going up 1,000 times. So I don't know, you're getting a little bit of the charlatan thing in play here. And so that's why I'm skeptical. But from an index standpoint, okay, we're coming down. So it feels like I said, it feels like they knock it down and then let it lift. Maybe you hit a bunch of buy stops and they let it lift again. Here comes everybody piling in. Same thing with the S&P. So nothing surprising here. Down 3 days, you hit the 20-day line, and now we'll see what happens from here. If we look at gold and silver, gold is off $10. Is that right? No, it's actually, $290. So it's not really moving. It's correcting a little bit, which, it's entitled to, but silver is still going bonkers. Another new high. Volume rates right now are at above average levels, well above average levels. You can see it's almost gotten to a full day's worth of volume already. And it's making new highs. So I think silver's going to 50 at some point, maybe sooner than later. And certainly we've been following that for a while now. But the miners some of these are taking a break. And we'll see how this goes. Because now everybody wants to buy miners, right? Nobody also ever talks about this, which I think is interesting because it was yesterday or the day before I just channel surfing financial cable TV, and one of the channels had a big to-do about Palantir, number 3 stock in the S&P 500, blah, 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 in 2025, blah, blah, blah. But the number 1 stock in the S&P 500 in 2025 is Newmont Corporation, the biggest of the big stock miners. Interesting, huh? And it's interesting the media does not talk about it. I've been thinking when they start talking about this being the number 1 performing stock in the S&P 500, which you won't hear a peep about it, then maybe that's the top. Otherwise, you see Newmont get support near the 10-day line today, and so they're hanging in there. They might correct and consolidate for a while, but so far they do not seem to show any signs of wanting to come apart. So anyways, I'll run through the group. You see Agnico coming right into the 10-day line. So far, normal pullback. Some aren't even as far as the 10-day line, like Anglo Gold Ashanti is, Alamos Gold isn't. So, I'm looking at the 10-day or the 20-day line, and I'm just hanging back and just letting them do their thing. I mean, like I said, I don't really feel like I need to be long anything. So if I'm up pretty good for the year, why do I need to stick my neck out here? I found the short side to be a little more friendly than the long side in most cases, and I'm finding a lot more short sale setups than I am long setups. So I'll just finish off by going through my intraday notes. You can see all of these oil mining, they have problems. Just finish off with the silvers. Silver's going higher, so the silvers are up for the most part. But you know, they look like they're in pullback mode, consolidation mode. So I don't see any reason to force the issue. I sold the last of my stock, gold and silver stocks a couple 3 days ago, but I'm still long the metals themselves, because I think if the market comes off, forced selling might bring the stocks down. But I think gold and silver may benefit from their status as safe havens in an era where you have central banks accumulating gold hand over fist. And now you have Morgan Stanley at Goldman Sachs coming out and changing the historically entrenched 60-40 asset mix, 60% stocks, 40% bonds, to 60-20-20, which is 60% stocks, 20% bonds, and now 20% gold. So if they have to start buying 20% gold, then that's a lot of buying in gold. So I would expect it to hold up better. Also, silver, just massive shortages there that are just like off the charts, absurd. And so some of that's coming home to roost. So we'll see how this all goes. But just real quickly, I just want to go through what I'm looking at on the short side, because the fact is, on balance, I've been finding things mostly on the short side. Like 3M, you know, busted 20-day line yesterday, busted 50 today. That's an economically sensitive name. Adobe Systems looking like a short at the 50-day line. AMD is short at the 20. AeroVironment, this is a century mark short because it closed yesterday above the 300 level, 301.52, and then today broke down to the 10-day line. So everybody comes in and buys it there, which seems kind of normal to me. But right now you're looking at a century mark short sale entry using 300 as a covering guide. We'll see how that plays out. AMAT is a bit of a double top setup, but you see support off the low. So they want to come back into these names, these hot names. But you have this left peak at 201.11. We're trading right now at 200.43. We'll see how this goes. Maybe it double tops here. I don't know. Anyways, Best Buy, you know, weak rally into the 200. Block Squares short at the 20 and the 10 and the 50. Booking Holdings maybe a short at the 20. CarMax blew up today, so they're doing really well, right? Cisco coming up into the 50. We'll see how that one plays out. DR Horton, I showed you that. Freeport-McMoRan, they have a mine in Indonesia that's shut down, and it looks like things are going to be a lot worse than they thought initially. So that thing blew up. That sent the other coppers up, also sent the price of copper up yesterday, because now they're looking at supply constraints because of this. So, but look at them just take this thing apart. That's one of the risks of miners, okay? They can announce a mine, you know, collapse or something. And so that's one thing you have to guard against. One way to do that is, instead of just being heavy one, the way I'll do it is I'll go in with 3 or 4 or 5 and be spread out. It doesn't completely eliminate the risk, but it does take some of that away. The other thing is, when you look at something with like Freeport-McMoRan, if you were long it, let's just say you were long it on what that Tuesday, the day before it broke, and it breaks down, you see it, you sell it, you go short. It's a shortable gap down. I mean, it opened at 41.99 and it never looked back. So you could have shorted it right there, use a high as a covering guide. Then it blows through the 200-day line. That's another short entry, and continues lower, gets below this. This is a late August peak or late July peak, and now it's going lower. So see, that's one way you can recover, especially if the news is bad. So a 360-degree approach often is useful if you're fast enough and smart enough. Most people probably wouldn't figure that one out. KB Home, McDonald's, most of these I've talked about. Netflix busted the 50-day line yesterday. I think it's just above it now, but now running into 20-day line, something to watch. So, you know, we'll see how all this goes. But for the most part, I'm finding some things on the short side. They tend to work. A lot of it is tactical, where you get short and you might catch a 1 or 2 day break and then things will bounce. I think you're seeing a little bit of that today, but we'll see how this plays out. But that, you know, that's my approach. And my feeling is I don't really need to get heavy long anything, particularly if it's extended, which many names on the long side are at this point. Anyways, that's all I got. Got anything else, Chris?
No, we're okay over here.
Cool. All right. Thanks for showing up, everyone. We'll catch you next week. Take care.
So long, everyone.